as you all know, in business, it's supply and demand. The only reason that buildings would raise rates is that they know that there will be people who will be renting with them. There will be people who would want to go and get their space, because at the end of the day, if they raise rates and people have other options, meaning there might be other buildings that they could transfer to, they'll ultimately settle for not increasing the rates as well. I hope you're getting what I'm saying, that ultimately it will just be a supply and demand play. Hey guys, so as you all know, I'm a very big fan of REITs because it allows you to have the best of both worlds. It gives you the ability to earn capital appreciation because of the nature of it, that you are buying a stock-like asset. As you all know, when it comes to real estate, if it's in a good location and then there's a lot of people renting it, property prices generally go up in areas where a lot of traffic in that area and a lot of demand of people who want to move, transfer, transact, and stay in that particular place. And that being said, majority of the REITs that we have are primarily based in areas where there's a lot of traffic, there's a lot of people trying to go there, there's a lot of businesses that's there. That being said, it places a larger amount of demand for that particular area, building, and in turn also they get to raise rent, further increasing the value of the property. So you have capital appreciation, but not just that, you also have dividends, which in my opinion, if you have predictability of income, you have the ability that you buy this particular REIT and it's exposed to this particular buildings, and you have the predictability that, hey, you have so much people, businesses renting in that area and they're massively full for a long period of time, then you get to think that maybe the dividends that I could get from this is somehow predictable, because I know that this building has a lot of tenants, and as there's a lot of tenants here, the rental income will be steadily fixed for a long period of time. We had a good share of REITs already from the past few years, from A-REIT, M-REIT, RCR, Gedfield REIT also come out, and this year there will be a bunch of new REITs that will be interesting, will be amazing, that will give more opportunities for people to have exposure to the capital markets, and in turn also let their money work hard for them. For those who are new also and are asking what's REITs, please check it out in the description below. I have tons of videos that I've created since 2019, more than 2020, talking about what REITs actually are. That being said, if you're watching me for the first time and you still don't understand what REITs are, REITs basically is a company and you buying shares of that company, and since it's a company, it's supposed to have a working business, and REITs make money because the company itself is a building, and the building, they have tenants. Please do note that the iterations of REITs that we have right now are mostly business related, or mostly office spaces, but REITs could also be hospitals, it could also be commercial spaces, could also be highly connected to e-commerce, and the space that it takes also in terms of fulfilling those orders, could also be highly connected to renewable energy, or it could be connected also to data centers. So REITs could be anything, not just office spaces, but the whole context of it is you are benefiting from the ownership of the company, and the company's revenue model is basically coming from the rentals. Now, that being said, a lot of you guys have been asking, what's my take in REITs, especially the new ones that are coming, and I want to make this video as to give you somehow a template or a basic ideology on what I look for REITs. And as you all know, there will be different REITs that will be out there. There will be different companies, and the nature and the structure of how the REITs are will be primarily different. So I want to share this so that even though you're watching this right now, 2022, this will be timeless principles also that could be watching this 2027, 2029, 2031. You can just go back and look and still watch, because this will be foundational and that you can use over and over, regardless if there will be new REITs that will be coming out, or new brand or new company that will be selling their shares. Every time companies sell in the market, their whole narrative is to raise money, regardless of it for expansion, buying more buildings, or just acquiring. The ultimate goal for them is to raise money, and as you all know, every time they raise money that route, they're selling shares and you're buying shares. That means you become a part owner and a shareholder of that particular company. For normal stocks, the risk there is basically a company may opt not to give dividends, which is the case for some companies that are growing. I don't know if you remember this. I interviewed the CFO, the COO of Converge, and since they are in growth mode, they are massively growing, majority of the proceeds of what they're earning is going to that rapid expansion phase. Hence, the growth that they have is also flipped in a way that they're not gonna give dividends, at least for the near term. They know what to do with the money. But for REITs, automatic, the main structure of how it is it's there to give you dividends. So when they raise money, there's an underlying expectation already that 90% of what they're earning should be given out as dividends to the shareholder. So there's an expectation already of you get a rent-like return without you buying an apartment or without you buying a condo or without you having to rent things up. And that's one of the biggest advantages of REITs, in my opinion, is that you have a rental-like property where you skip all of the hassle of trying to figure out, how do I get my tenant? How do I do customer service with this? What happens if they leave? What happens if there are things that need to be fixed? All of the headache of trying to manage your own property will be skipped already because you are just buying shares of a company. I think that's one of the merits that you need to also realize, and that also when you're looking at REITs, especially the ones that have high occupancy, then it won't be your concern, it won't be your problem that, oh no, there's no one renting in your apartment or your condo. And that's the reality also right now. Residential condos, particularly in the center of Manila or in the center of where businesses used to be, given the theme, no, that everyone, there's a large chunk of people that are working from home. I think even after this pandemic, work from home will still be a relevant theme, has pushed a lot of people that used to live in condos and in the city with smaller spaces to go outside, to go into areas where there's a lot of fresh air. Since they don't need to report to the office, then I'll just get a bigger space. Since they don't need to commute anymore, they don't need to travel anymore for 1 hour or 2 hours, then there's no compelling reason for them to stay in the city. That's why there's a lot, no, in some condos, it's relatively either harder to have it rented out, or in the same way, if they have the ability to rent it out, it's somehow lower. That's one of the biggest advantages of at least the companies that have sold their shares as part of REITs. Why? As you all know, everything that they would share is disclosed. Everything, when they start also listing, they would have to share who are their tenants, how long is the average lease, how big of a percentage of their buildings are occupied, and are they actually raising rents? That somehow reduces your risk, no? And I want to say this, that if you're trying to look for a template on how you're supposed to analyze and at least buy REITs, is look for, in my opinion, it has to be a really, really, really good company. It should be run by excellent people that know what they're doing, that know what they're getting into, and know how to treat their tenants well. Because as long as their tenants are treated well, they're gonna stay there. As long as the management of the building, the company is done well, they're gonna stay there. And it will be a very, very harmonious relationship where they could stay for a very, very long time. So that's one. Number two is, of course, look at the numbers. It's given that they should be making money, and of course they should be making money as long as they have tenants. But you have to realize this, that because, as what I've mentioned, there's a shift from work from home, look for the projects where their buildings are relatively full. You want as much as possible close to 100% occupancy. And if you have a choice between project A, B, C, and D, and then this one has 98%, this one has 99%, this one has 95%, this one has 90%, go for the one with the highest occupancy rate, because it gives you the probability that, okay, they're relatively full, then there's a larger chance that whatever they earn, it becomes more predictable also in my end. So look at that, but above and beyond that, also look at how long are they gonna be occupied. Look at the average lease that they have. Is it 3 years? Is it 4 years? Is it 5 years? Is it 6 years? Because in my opinion, the longer the average lease period is, the more predictable it will be for you. So if the lease is around 3, 4, 5, 6 years, then at least you already have a narrative that, hey, it's 2022 right now, the average lease is 2027, 5 years. So that gives you 5 years of predictability that if the dividend yield that they're actually giving is around 5-6% from the time that you actually bought it, then there's an expectation that it may be around that point also, that it won't anymore shift, it won't drop massively, because that's the level of income that they'll probably get also over a period of time. Above and beyond the occupancy rate, above and beyond the tenure of people actually staying there, what I like also to look at is, are they actually raising rents? Have they actually done it? Those companies that raise rents during the pandemic means that they're in a building that has a very, very high demand. Why? Because as you all know, in business, it's supply and demand. The only reason that buildings would raise rates is that they know that there will be people who will be renting with them. There will be people who would want to go and get their space, because at the end of the day, if they raise rates and people have other options, meaning there might be other buildings that they could transfer to, they'll ultimately settle for not increasing the rates as well. I hope you're getting what I'm saying, that ultimately it will just be a supply and demand play. All of these that I've been talking about are highly connected to how the business is, how it's actually run, the location. I think this also plays a very, very important part, that you know the dynamics of the business, or at least the area of what they're trying to specialize on. Is it a company that's focusing on tenants that are in the PO sector? Is it something that's connected to POGOs, or are they trying to focus on headquarters of the largest companies in the world that are stationed here in the Philippines? And that would be a very, very interesting narrative as well. Or is it a company that's highly connected to renewable energy? And as you all know, I've been a big fan of renewable energy, because renewable energy is the game. We're not gonna go back anymore. I'll never stop saying this, that if you have the ability to invest in a company that's trying to make the world a better place, but in doing so they make a profit, and because you are a shareholder you also make a profit, then it's a pretty sweet deal. It's amazing if you find the sweet spot that you're investing in something that you know is making a difference in the world, but in the same way you're also earning. Then that's something that's really, really good. But above and beyond that is this: very, very important that you are very sensitive in the price that you are buying it, because the lower you buy it, the more attractive your dividends will be. The lower you buy it, the more attractive the dividend yield will be. And I've been very consistent about this in the videos that I have made about dividends, that for me, I need at least 5% dividend yield for it to be very, very attractive. So I don't know what your parameters are. Do you want 4%, 5%, 6%, 7%? But ultimately, what's very, very important is you have to be sensitive at the price that you're buying it. The name of the game is still buy low, but not sell high, primarily because you're in it for dividends. But you buy low because it increases your dividend yield. It increases the ability for you to earn higher based on the dividends that you will actually get. So my suggestion, be sensitive about the price that you buy it. And it's highly important that if you have the ability to buy it lower, don't be scared when prices drop, especially for companies that you know very, very well, especially for companies that you've spent a lot of time to be able to learn and build a conviction in. Because at the end of the day, it will always be a high conviction game, that you always put in money in what you understand and what you know. And when it drops, please do note that since it's REITs, since it's in the open market, there will be times that there will be selling pressure. And when there's selling pressure, you would actually see it drop. If you panic, if you get scared, you will sell. And that's why it's so important that you know what you're actually doing. It's so important that you know how to deploy capital. It's so important that you have full conviction in what you're getting into, because as it drops, and then as you know the company very, very well, it gives you the ability to buy it low, thus increasing also your dividend yield that you could possibly get from that particular REIT. If you guys want to know more about REITs, number one, I have playlists down below talking about REITs. Number two, I have a course happening this March. It will be a live Zoom course, but I'm not just going to talk about REITs there. I'm going to talk about stocks, I'm going to talk about bonds, I'm going to talk about Bitcoin, I'm going to talk about altcoins, and I'm also going to talk about NFTs as well. It's a 6-session course. It's a masterclass with the goal and the heart to educate you and equip you and give you the right information and foundation when it comes to investing, when it comes to your money. And that's why we're going to talk about a slew of investments: REITs, bonds, stocks, Bitcoin, altcoins, and NFTs as well. So there, check it out down below. I have books also. If you want to invest in cryptocurrencies, we have that as well. If you want to try to have a piece of the metaverse and get a replica of Earth, we have that as well. So check it out, and I hope you guys got a lot from this. I hope that this was something that was insightful. This was something that was helping you. And if you guys have any questions also, feel free to put it in the comment section down below, and I'll try to answer it via video form. And if you made it up until the end, appreciate it if you could like, subscribe, and share, and smash the bell so you get updated every time I come up with new content about investing. So this is Marvin Germo. I hope this video helps you trade well, trade strong, trade smart. See you all again soon, and God bless you all.